Well, Buddhas, what up? Listen, I'm starting a YouTube series and I'm going to be teaching you guys about the stock market and how to invest. So what you're going to learn is what's a stock, how to make money from stocks, index funds, and I'm going to show you how to open a stock account. You ready? Let's get it. All right, well, Buddhas, this is Investing 101. So what this first slide shows us is if you started with $1,000, where would your money be in 30 years? And we have three options. We have the checking account, we have the savings account, and we have the investment account, which is the stocks, right? So the checking account, what you're gonna receive annually is 0.5%. On a savings account, what you're gonna receive annually is 0.9%. And on the investment account, what you're gonna receive annually is 7% on average year after year. Now, as you can see on this, this slide, that after 30 years of that one investment, and you didn't put not one other dime into it, the checking account went to about $1,300, right? And then we look again, we see the savings account that probably went to $1,500. What you can see on the investment account, which averaged 7% a year, you started with $1,000 and they're at $7,200. So that's a big difference. And it's part of the reason why I encourage people to get into the stock market. All right, so we go to the next slide now. So we can see that this slide is about compound interest and how it works. So if we have two investors here. Investor one, she started at 25 years old. She set aside $5,000 for 10 years. So from 25 to the age of 34, she invested $5,000 a year, right? We have investor two. He started at 35. So he invested $5,000 a year from the age 35 to 65. And who ends up with more money is very surprising. Because I would think that investor two ends up with more money than investor one, because investor two, he invested more money over a longer period of time. Well, as we can see, investor one started earlier, invested less money than investor two overall, but gained in the end at 65 years old, had more money, over $100,000 more than investor two. So this is surprising. This is something called compound interest. And, what's his name? Albert Einstein said compound interest was the eighth wonder of the world. Because as time go on, things start to compound money-wise, and it just starts to explode. So let's go to the next slide. Now, I'm pretty sure everybody have seen FDIC before. It's on every bank statement. As soon as you go in the bank, you should see it. And what FDIC insures you is up to $250,000 for every account you have, right? Just in case something happens, like the bank defaults, the bank run out of business, the government is insuring you that you get $250,000, up to $250,000 of the money you have in there, right? So if you have $10,000 in the bank fails, you get your $10,000 back. The government is guaranteeing you that. And we have something else that a lot of people are not familiar with, which is called the SIPC. Now, this is in stocks. So what the government is guaranteeing here in this one is that up to $500,000 in assets, right, value of your money, you'll be covered, right? So that means that if that investment brokerage fails, you're gonna get up to $500,000. So what it's actually saying is that you're more secure with your money invested in the stock market than you are investing in the bank, right? So this is why I tell people get into the stock market. Okay, so let's go to the next slide over too. So we kind of went over reasons why for you get a stock market. Now we break down what's a stock. All right, so a stock is a share of ownership of a company that can be issued private through companies or sold publicly on the stock exchange. So all these companies that you use or companies that you don't know that you use are on the stock market, most of them. Right, so if you have a Hanes t-shirt, right, like that's on the stock market. Your Nike sneakers, that's on the stock market. Your Google, when you Google something, you could buy Google, right? That's on the stock market. That's under Alphabet, its parent company. When you go to Starbucks, you can buy that in the stock market. When you go to Dunkin' Donuts, same thing. You can purchase all these companies on the stock market. And when you buy a piece of the company, you become something called a shareholder. So a shareholder is any person, company, or institution that owns at least one share of the company. Shareholders are part owners of a company and are entitled to all company profits. So you can see that Facebook is owned by 30% employees, 24% by Mark Zuckerberg. You have, see Goldman Sachs in there, they own 3% of it. And this whole pie chart of Facebook is broken down all the way, even to the small individual. So I could buy one stock of Facebook and I'm part of that shareholder. Like I'm a owner or a part owner of Facebook. Okay, so this is what I tell people, like, if you're gonna purchase these brands, use these brands, buy stock and become a shareholder. You know, so the next question may come to your mind is, how do you make money from stocks? Okay, now there's two ways to make money from stocks. Is one, when you purchase a stock at a certain price, the value of the stock going up. So for example, if you bought Microsoft here in 2010 for $25, and today Microsoft is worth $200, right? That's the value of your money increasing. That's one way you can make money off of stocks. The other way is called a dividend. So usually a dividend comes in every quarter. So that's every 3 months. The company pays its shareholders a piece of its profits. Not every company does this, right? But the ones that do, they usually pay their shareholders every quarter or every 3 months. Okay. Some do it semi-annually. That's every 2 years. Some companies do it monthly. That's usually like REITs. Okay. So a dividend is a portion of the company's profits that's paid out to shareholders. Dividends can either be issued from cash or shares of the stocks. Now, what I recommend people to do is, when the company sends you a dividend, is that you just reinvest the dividend back. And that's called a drip. All right. So if some of you guys don't know, you probably definitely heard of these big indexes: the S&P 500, the Dow Jones Industrial Average, and you probably definitely heard of the NASDAQ. So the S&P 500 is just the 500 biggest companies in America, all into one, right, index. Okay. The Dow Jones is usually the 30 top companies in America. Okay. The NASDAQ, this is really a big tech, right? A big tech index. So they'll have like the Facebooks, the Apples, the FANG companies, Facebook, Apple, Netflix, Alphabet, which owns Google, and Microsoft. Those like big tech companies, they'll be in the NASDAQ. Okay. So next we're gonna go into like what an index fund is. So those were the major ones. Now we're gonna go into what an index fund is. Shout out to Wall Street Travel, by the way. I use his Instagram story for this real quick. So an index fund is simply a fund that will allow you to purchase a whole market or index, right, through the S&P 500, Dow Jones, or the NASDAQ. It's similar to a mutual fund, but without all the high fees and necessary portfolio manager making your picks. On average, this is year over year, you'll get 11% return on your money. Okay, and usually S&P 500 ticker symbol, a good one is VOO or SPDR. Okay, so again, if you think about all the 500 biggest companies in America, you know, that's the S&P 500. Okay, so you have your Apples, Microsoft, Chevron, Johnson & Johnson, Bank of America, AT&T, MasterCard, Visa, and so on and so forth, right? So when you buy the S&P 500, for example, you're buying all these 500 companies, the 500 biggest companies in America. You're buying into them, okay? So let me explain to you guys, like give you guys an analogy, right? Because I like, me personally, I like analogies. I like sports. So investing in the S&P 500 or an index is similar to having a basketball all-star team, right? So, like, this is an example, right? If you were to invest into basketball players, right? Based on talent, you would most likely invest in a player, right, who's better for future success, opposed to invest in a player who's worse or someone who's declining. So I would rather invest into Klay Thompson than to Harrison Barnes. They're kind of similar players, but Klay Thompson is a better player and he probably has a higher horizon compared to Harrison Barnes. However, life happens. A player could tear his Achilles like John Wall did, retire like Jordan multiple times, okay? A player might train all summer and become an all-star talent like Jimmy Butler, right? Like, you don't know, but like stocks, the more you research a company, the better your investment can become. If you were indexing players, you would gather the top players and invest in all of them. Just in case some drop off, you're able to benefit from others. So what that means is, if I were investing in basketball players, for example, and I wanted to index the players, I would take the two all-star teams, the East and the West All-Stars, and I will make a fund and I will invest into that fund. So again, just in case we have a player like DeMarcus Cousins, John Wall, they go down with injury, you have other players like LeBron James, you have Giannis, you have James Harden, who could balance it, could keep it up, right? Because you don't know what's going to happen. Any moment, stuff happens in the stock market, right? So you need things that's going to balance it, keep it afloat, right? Same thing in basketball, this analogy, and the same thing happens in the stock market, okay? So part of the reason why I really like the stock market is because I can invest in it from life to death. And what do I mean by that? So we have a bunch of healthcare companies in the stock market, and one we're going to look at particularly is HCA, right? So that's a company that provides healthcare for people. You can actually buy the stock, right? So that's life. Now we think about to death, right? I can invest in funeral homes, right? So when we have people dying, the funeral home stock price will going up, right? So it works from life to death, right? Also, why I really encourage like the stock market is I could buy a company such as Gucci, right? And I could buy things around Gucci. So this is like a 360 kind of thing. So what I mean by that is, so you could buy the company, right, that Gucci has his store in, right? So the mall that Gucci has a store in, which is Simon Properties, right, where some of the Gucci stores are in, you could purchase that company on the stock market, and you could purchase the Gucci on the stock market, right? And then going further, I could invest in a company that takes out Gucci's trash on the stock market. And this is what I mean by the whole 360 of things. And there's other things too that you probably wouldn't even think of, like, oh, I can invest in that. So it's very similar. Like, you can invest in so much things in the stock market, like the possibilities are endless, you know. So that was a quick summary of the stock market. Now next we're gonna get into where you could go to buy stocks. Now, places you go to buy stocks, you go to like E-Trade, Vanguard, Robinhood, Charles Schwab, TD Ameritrade, or one like Fidelity. So I'm actually gonna open a stock account, show you guys how to open one, and just run you through that. And I'm gonna open a Fidelity one, and we can see what's up with that. All right, well, this was Investing 101.